to it. So please prepare your answer. Okay. And 강주현, right? 강주현.
Our investment idea is invest from China fund regarding consumer goods. It's because domestic consumption of China is highly growing, so I decided.
Yeah. That's all. 랭게 두요. Do you agree to your idea?
I think in China there are many of the manufacturers. If you focus on manufacturing, I think they'll be fine because they have lower cost, and the price of the yearly article is low. So and also the human source. So I think it's
This is good idea or bad idea?
May I ask, how did you get?
Good.
How did you get to the idea?
Good question.
Actually, I took a lecture. In Seoul University, and he highly recommended that. And also, I searched the Google about the Chinatown, and GDP was something like that. I will search many articles a day.
So what the article say? What do the article say? And you should have your own logic. You cannot say, oh, someone said that, some who said that. You shouldn't say something like that. You should have your own idea.
I think I know the argument, because China used to export about 30% of its, or about 80% of its products, and now that's brought back to 30 or 40%, and the rest is for the own market. So,
How do you think?
China's export rate is high.
yeah. But China's export rate used to be very high, and
I
now,
think domestic consumption is also growing. So
yeah,
I will focus on that.
yeah, because the export rate is going down.
Yeah, that's
So,
right.
yeah, market is changing. Good idea.
Okay, for me, you were talking.
My investment idea is the growth is behind the developing countries. So basically, I would encourage investors to invest into small and medium enterprises that deal with agriculture, basically food, or healthcare products or services. First of all, why developing world? Because raw materials and the labor cost is cheaper there. Second of all, the growing population will always stimulate the demand for such products, especially healthcare, with the prospect of increasing level of living, cost of living, basically. And we know that developing countries will always offer higher borrowing rate as compared to developed countries, because such countries always are hungry for funds. That's one of the incentives. But what are the benefits of it? The benefits, of course, large yields. As I said, the return will be much higher than developed countries. And second of all, there's an aspect of social responsibility. Investing into such countries, there is a high risk, but also if things turn out well, then first of all, it's a creation of jobs through foreign direct investment, and second of all, such investments, I mean in large numbers, of course, will increase the level of living in such developing countries so that they can actually be more competitive with already developed countries. And why I encourage SMEs, not corporations, because corporations in developing countries which are very fragile to political situations, once such an economic downturn happens due to political changes or so, corporations will usually start laying off people straight away, cutting jobs. But whereas SMEs, they will be a little more tolerant to such events. So I think in terms of that, and plus giving developing countries, I would very much consider the social responsibility part. Because that's where we can see the most of the world lives in developing countries rather than developed. So it's both chasing good investment opportunities and doing something more.
Thank you. Any question? So again, this is the first question of the midterm, and it will be a start of your term paper, which are very important to you, right? So please put more effort to develop the ideas. I keep putting your name.
Abdullah is the first.
Okay. 박민산, 옥타비아, 주창호, 이지수, 박준욱이. And today's presentation is chapter 5, chapter 7, 통영. Why don't you start first? Your presentation.
Yes, sir.
Okay, thank you.
Hi everyone, today I will going to talk about the risk and the return. Firstly, let's say after studying this chapter, you should be able to use the data on the past performance of the stocks and the bonds, and to characterize the risk and the return of these investments. And secondly, you should determine the expected return and the risk of portfolios, and they are constructed by the company's risky assets and risky-free assets in the T-bills. And last, you should to evaluate the performance of the passive strategy. Firstly, let's have a look at the risk of the return. A key measure of the investors' success in the rate at which their funds have grown during the investment period, and the total holding period return of the rate of the share of stocks depends on the increase in the price of the share over the investment period, as well as any dividend income and the share has product. We can calculate it use the formula, and it is I didn't write on the last. How to calculate the HPR is ending price minus beginning price, ending price minus beginning price, and then plus the cash.
Can you use other color, please?
Yes.
Color?
Oh.
Yeah.
And this is a beginning price N plus cash divided Y. And divided by the beginning price. And this is how to calculate the HPR and the holding period return. Then measuring the investment returns over multiple periods, and we have the two kinds of average and then the dollar weight return. The difference between that, I think the two kinds of average, we have already learned it before, but the dollar weight return may be the interest rate of a return on an investment, the internal interest rate of the investment. Then next, we have seen that there are several ways to compute the average rates of return. There are also some variations in how the multiple fund in our example might be analysis, and it is called quoting rates of the return. If we calculate the quoting rates of the return, we should know APR first. APR is can be translated to an effective annual rate. So the period per year, patterns per year, multiplied is ln 1 plus EAR. And what is for calculate the APR, we can use an example like a credit card company might change 1% a month, but the APR is 1% and multiply 12 months, and it is 12%. Then EAR is effective annual rate. It is also called effective interest rate. Therefore, to obtain the EAR, if there are compounding periods in the year, we first recover the rate per period at APR divided by N, and then we got this, and the calculation of EAR, and continue compounding. The EAR divided by the greater amounts from the APR as N becomes larger. In the limit, we can equation continues compounding where N becomes extremely large. So limit. And finally, we will get this APR equal line 1 plus EAR. Next, let's have a look at risk and risk reviews. Any investment included some degree of uncertainty about the future, maybe holding period returns, and in many cases that there are something uncertain, we call it risk. Analysis of this multiple source of risk is in the next part. Firstly, let's review the scenario analysis and the probability distributions. Scenario analysis, when we attempt to quantitative risk, we begin with the question, what the HPRs are possible and how likely they are. How likely are they? A good way to approach this question is to devise a list of possible economic outcomes or scenarios and specify by the likelihood. Therefore, this approach is called scenario analysis. And the list of the possible HPRS with associated probabilities is called the probability distributions of the HPRS. The expected return is the mean value of the distribution of the HPR, and then the variance. Maybe we have learned it in the mathematics. It is the expected value of the square deviation from the mean, and the standard deviation is the square quote of the variance. Okay. The normal distribution. It is essential to the theory and the practice of the investments. And let's say the bell curve, bell-shaped curve. It is called the. Can you say it clearly? It is called bell-shaped curve because it is like a bell. And the picture shows that if the return was normally distributed and the roughly 2/3, like 68.26% is one deviation. Is one standard deviation from the mean, and the mean is 0. So it is a meaning of that would be no more than one standard deviation away from the mean is quite high at 68.26%. And then we have here and the meaning was there are no more than 95% and 44. Then the 2 times of the standard deviations. Okay. The value and the risk. Suppose that you are worried about the return of your possible investment losses. If we do some investments, we may lose something, and this is how to calculate the value and the risk. We have to prepare something
I think it's not correct.
Yes.
It's not correct. So why don't you go to next slide?
It's not correct.
No.
I just took it on the book.
Yeah, but there is something wrong with the
Okay. Okay, let's have a look at the risk, the history of report. World and U.S. risk historic and bond portfolios. There are the world portfolios of stocks is diversified across the large capitalization stocks of 16 developed countries, including U.S., Europe, and Japan. And the world portfolio of bonds was constructed from the same set of countries as the world portfolio of stocks using long-term bonds from each of the 16 countries. Next. And this form shows, as you can see immediately, that the differences between the two kinds of average, and the difference between them is close to 1/2 of the variance of the returns for large stocks, world and US, and suggesting that these distributions may be no more, and there is greater for small stocks. Next is inflation and the real risk of return. And at any time, the price of some goods may be rise while the prices of their goods might be fell. The general trend in prices is measured by examining changes in the consumer's price index, and it is called CPI. CPI measures the cost of the purchasing a bundle of goods that is considered the representative of the consumption basket of a typical human family of four. Suppose that the rate of inflation, the percentage changes in the CPI. We need to distinguish between a normal interest rate and the growth rate of your money, and a real interest rate is the growth rate of your purchasing power. As the difference between the normal interest rate and the real interest rate. In fact, exact relationship between the real and the normal interest rate is like this. The relationship between this and finally, I hide something. And the big R is normal rate, and the small r is a real interest rate, and the I is inflation rate. So finally, it is this, but I hide that thing here. The history shows us that the long-term bonds have been the riskier investments than investments in T-bills, and the stock investments have been riskier still. On the other hand, the riskier investments have offered higher average returns. And what is a set allocation? It is the relative choice and among a broad investment classes. That's a risky asset. We will still shift wealth from the risky portfolio to the risk-free asset. We do not change the relative proportions of the variety securities within the risk portfolios, and rather we reduce the relative weight of the risky portfolio as a while in favor of the risk-free assets. The power to tax and to control, the money supply lets the government and only the government issue wealth-free bonds to government. The only risk-free asset in real terms would be a price-indexed government bond. Even then, a default-free, perfectly indexed bond offers a guaranteed real interest rate to an investor if an only majority of the bond is identical the investor's desired holding period. Money market funds good. There are three types of that. It is T-bills, backed certificates of the deposit, and the commercial paper. portfolio expect return and risk. Now that we have specified the risky portfolio and the risk-free asset, we can examine that the risk-return combinations that result from various investments allocations between these two assets. See the picture. Yes, please assume the compositions of the optical risky portfolio already have been determined. The concern here with the proportion of the investment Y is to be allocated to A. The remaining proportion 1 minus Y is to be invested in the risk-free asset. The capital allocation line. The line plotted in figure, just like that picture. That is the risk return combination available by varying assets allocation. That is, by choosing different values of Y for this reason, and it is called the capital allocation line, or CAI. The capital allocation lines show that the risk-return trade-off available by mixing the risk-free assets with the investors' risky portfolios. And investors can choose these assets included in the risk portfolio using either passive or active strategies. A passive strategy is based on the premise that the assets and offer down overvalued assets by selling. You have to conclude that most of the time, the most assets will be fairly priced. And finally, the capital market line is the capital allocation line that it results from using a passive investment strategy that the trees and of market index portfolio, such as the standards and the Poor's 500. And how reasonable is it for the investor to pursue a passive strategy? First, the alternative active strategies entails costs. Let me explain the first thing. Whether you choose to invest your own valuable time to acquire the information needs to be generated optical active portfolio of risky assets, or whether you delegated the task of professional to who will charge a free, and constructing an active portfolio is more expensive than constructing a passive one. And the second one is arguments supporting a passive strategy is free rider benefit. If you assume there are many active, knowledgeable investors who quickly tied up the price and undervalued it. So you have to conclude the most of the time and the most of assets will be fairly priced. In the summary, that we could say the capital line is a capital allocation line, and the perceived strategies are low-cost ways to obtaining the well-diversified earnings, with performance that will reflect that of the broad stock market. Okay. Yes, as on phone. I have a question.
Aurelia, what is the effective annual rate?
Effective value.
So, Rangan just explained it. So, can you explain it again? What is effective value?
Effective value.
Effective annual rate, EAR.
EAR. There are a little bit difference between APR and EAR. I think the APR can be translated into effective annual value, and EAR may be the each period of the rate. I think the APR is divided into some small parts, and each of the small parts is called the EAR. That's my opinion. Okay, thank you.
Thank you. Yeah, I don't have time to explain effective annual rate. That is important, but I think there is good explanations on the web. Effective annual rate is labor, of course. Okay. Okay, effective annual rate. Effective annual rate. Effective annual rate. Okay. So, which is similar effective interest rate. Okay. Okay, actually, with effective annual rate. DC inside. I cannot believe. Okay. Yeah, there is APR and EAR, so definition. So please go over the concept. Okay. Okay. And I have a homework for you. Okay. So Ranghe, since you presented this part, so please help others to do this homework. Okay. Homework I'm about to give you. Okay. Okay, today is week 6. Week 6 homework. Today is 8. About 4th and Apple from .com. Plot, okay. Plot capital allocation line using both R and Excel. Okay. Very simple, okay? So, of course, if you go to fairnessgoogle.com, then you can basically download the stock prices. Okay, then you have to change stock prices into stock return. Okay? And once you transform the data from the price to the return, then next you have to calculate historical average and historical covariance. Okay. Then you can calculate, then you can plot basically capital allocation line. So, for example, this is the stock return of the Apple. Okay, stock return of the Apple. This is random value. And suppose this is stock return of the Ford. Stock return of the Ford. Then you suppose you invest W here, and you invest 1 minus W here. Then basically mean, okay. Okay, basically you cannot observe mean, but if you have enough data, historical average will convert to mean anyway. So mean is basically WRA, the average return. So it is not exactly you average operator. So if you calculate average return, then it should be look like this, right? And it is RF so you can calculate mean. Okay, you know how to calculate this. It is simply average. Okay, this is also average. And next, you are gonna calculate standard deviation of your portfolio. So first, we have to calculate variance, right? Variance of this one. Same. And of course, variance is square of the variance of the RA. RA fold, and then plus 2W 1 minus W of covariance of right Apple and Ford. Right. So you can calculate variance, right, and you can calculate covariance. And next, what you have to do is draw the plot. The x-axis is variance, standard deviation. So you calculate variance. So you have to do square root of this entire thing. Okay, and this is the mu. Mu is expectation. Okay. And if we draw graph, it should be look like this. Right. So please try. Very easy, right? I gave you the formula, right? And basically, they are the function of the W, right? It is the function of the W, okay? And we change the W, this and this change. So when you plot this, so you have to basically try different values of W. So you can change W, or I don't know which one has higher return, but you can change W, so basically you can draw this one. Okay. Just try a lot of W's here. Okay. From like 10 to minus 10, something like that. No, that's too extreme, so maybe plus 2 to minus 2 with the interval of 0.1. Okay. Too easy. Any question about the homework?
Question. In our coding, I think we should know how to define the variance of axes. Yeah. In the plot chart, yeah, on x-axis the sigma is noted, but
Okay, if it is too difficult to draw this chart, actually you can instead draw this chart. Okay, something like this. Okay, so x-axis is now u and y-axis is w. No, sigma. Okay, I think in this case it will be easier. Okay. So the idea is basically, actually there are many ways to draw this graph, but one idea is for different value of w, you can generate different value of mu and sigma. Okay, so for different value, you can generate like two columns of data, long data, and you can simply plot the two columns and you will get this chart. I mean, try with Excel first, and then okay, transform your Excel to the R code. I think that would be actually faster. And about value at risk, I will explain the concept to you with a practical example later on. And then next presenter, Yongwon.
Good morning, everyone. I'm Yongwon Song, and I'm going to introduce the chapter 7, the optimal risk portfolios. It includes the risk diversification and the course to choose the optimal allocation between risk-free asset and optimal risk portfolio. I will show those items. At first, I will introduce briefly the risk diversification, because the professor already covered, and the correlation and portfolio risk. And within this part, the key concept of this part is efficient frontier. And third, optimal portfolio select. The key concept of this is Sharpe ratio. And finally, as I said, optimal asset allocation between risk-free asset and optimal risk portfolio will be covered. And this chapter based on the paper of Markowitz issued in 1950, which makes him earn Nobel Prize. So if you want further idea of this chapter, I recommend you to read it. And part 1. You know what the risk is. There is two kinds of risk. And first, market risk. It's usually called systematic risk, and it's non-diversifiable. Quick example of this risk is natural disaster, like Japanese earthquake. And second one is firm-specific risk. usually called idiosyncratic risk. It's diversifiable, and the example of this is Steve Jobs' health issue in Google. Apple, sorry. This figure shows the risk diversification. Panel A doesn't care the market risk, but both panel shows as the number of securities in the portfolio increase, the sigma, which is the risk, is decreasing. Panel B shows how much. Panel B shows the maximum level of diversification is above the market risk. No matter how many securities in your portfolio, the market risk can be diversified. And chapter 2. Well, actually, I reformed this PowerPoint file in the course website, and there are so many equation and example calculating. Yes, but I'd like to make it easy, so I deleted some of them. So if you want to see omitted parts, visit the course website and download the original PowerPoint. Anyway, there is two security portfolios example. At first, the return is weighted average of each securities in the portfolio. In this case, there is only two kind of securities in the portfolio, so the return of the portfolio is low. And risk part, is it? It's similar to return, but there is added parts. The risk of portfolio is weighted average of each securities and correlated part. The previous equation can be translated into third one with the definition of the correlation, which is noted low. Well, is it familiar? This is the equation the professor wrote it on this blackboard right before. Yes, so I think this page will be helpful for your homework. And by the definition of low, low's range is from -1 to +1. Both are extreme case. If low is 1, the correlation between two securities is perfectly positively correlated. And when the low is -1, the security would be perfectly negatively correlated. Here's a table showing the return and standard deviation of portfolio. What we must look, what we should look is the portfolio standard deviation for given correlation. While the low is -1, which means the two securities are perfectly negatively correlated, the diversification effect is quite strong. Right here, the risk can be diminished to about half, but when the correlation is 1, the risk diversification effect is quite weak. That's why the correlation is very important in risk diversification. And go on to next slide. This is graph of return bearing the weight. This weight. Because the return itself is weighted average of each securities, so its shape is straight. However, riskiest case, following the low, the risk can be diminished. Except low is 1, perfectly correlated situation, the risk can be diversified and below the weighted average of each securities. This figure is combination of previous two figures, and well, the red line here is the minimum variance we can enjoy given correlation, and this is generalized case within several individual assets, and the line colored red is called efficient frontier, which means the lowest risk we can enjoy given correlation and given situation. Yeah, efficient frontier is very important to understand the next slide in this chapter, so please keep in mind. And yeah, optimal portfolio select, and key concept of it is Sharpe ratio. Sharpe ratio is well, this maximize the slope of the CAL, just Lange offered, Lange before, and Sharpe ratio is equation is risk premium divided by portfolio risk. You know, risk premium is the excess the return by taking risk. Yeah. And take go next page. A combination of capital allocation line and efficient frontier. Yeah. On this point, when the capital allocation line and efficient frontier is not optimally intersected, you can enjoy more just taking little risk and more return. It means the point, efficient frontier and capital allocation line is intersected, is the more optimal point of portfolio to invest. And because the slope of this capital allocation line is Sharpe ratio, the higher Sharpe ratio you can find optimal risky portfolio. And maybe there are some very risky offers investor who wants to take this level of risk. There's two for him in this chapter. I will talk later. Finally, optimal asset allocation. Key concept is separation property. Previously, I said there's optimal risky portfolio, but if it is so optimal and it's perfect, will investor invest in same? Every investor invest in same portfolio? The answer is not. It's not. And what determines the investment decision is risk preference of each investor. Yeah. In my case, I'm very risk averse, like just a normal Korean person. But there's maybe other person who risk loving, and he and my investment decision will be different. And I will explain with this figure. After finding the optimal risk for portfolio, there is indifference curve, which means the risk preference. If the investor is very risk averse, the indifference curve will be close to this point, less risky part. However, if the investor is very risk loving, the indifference curve will be closer to optimal risk portfolio, and in extreme case, he will go over the risk portfolio, somewhere like here. In this case, he will borrow some money in risk-free rate and invest the proceed the portfolio. In this case, the weight on portfolio will be above the 1, and the weight in risk-free asset will be below 0. It's usually called leverage. I believe there's some other chance to talk about it. And this is an example of final investment decision. Investor usually first he decides the comparative ratio between each securities, which makes the optimal portfolio, and then he decides the ratio between optimal risk portfolio and risk-free asset. In this case, TBO. And summary. Optimal asset allocation is key concept, main idea of this part. And separation property, I mean, allocating property between risk optimal portfolio and risk-free asset tells us that portfolio choice problem will be separated into two parts. First one is quite technical. Determination of optimal risk portfolio is quite technical. But first, obtaining some historical information about certain securities and extracting some expected return of securities and variance and correlation between each securities. The difference is personal preference, risk loving or averse. The location of risk indifference curve makes the difference of investment, and that's the separate. There's a separate property tells, and this is the whole course to make the optimal allocation, optimal asset allocation. And there's one thing add in this chapter. The insurance principle is that the author of this textbook kindly added this part to make us not confused with this risk diversification and insurance principle. There's an example of insurance product. It's called risk pooling. Suppose insurance company sells a product in tiny amount of money, and when some events happen, he will pay the consumer huge money. Though the return of the product is quite small, but the probability of the event will happen is quite low. The expected return of this insurance company would be positive. However, when he sells just one product, the standard deviation of his return quite fluctuating. Because there's large gap between huge money and tiny earning. But how about he sells a millions product, and each products are samely weighted, and the correlation between those products are zero. Then the standard deviation of insurance company would be like here, when each asset rate is n, 1 divided n, and each standard deviation are supposed to be same, and correlation is 0, then we can earn this standard deviation. We can, if the insurance company sell millions of products, their standard deviation is quite low, and it could reach the risk-free level. Is it possible? How about the worst case? When such an event happens at the same time, they should pay huge amount of money, millions times, which makes the insurance company will collapse. By this example, the risk is not actually diversified. The real insurance principle is risk sharing. Risk sharing means exposing the risk how can I say? When some risk is quite exist, and exposing each consumer, I mean the insurance product consumer in the part of risk, and the consumers sharing the risk is risk sharing, and it's the real insurance principle. I think the author of the textbook wants us to not confusing with risk diversifying and risk sharing, but I think I failed to understand the risk sharing entirely, so my explanation is quite not so good. And here's my presentation end, and I have a little time for question and answer. Is there any question? No? Thank you very much.
And there are another related homework. So now Yongwon should help. Okay. No, it is not difficult homework. Don't worry. Okay. Okay. So this is 1. Then fourth, apple. F is -1. You can create risk-free portfolio if correlation, if the correlation is 1, CAL, okay. CAL is linear. Prove these arguments both graphically and mathematically. I think you can find this answer on the web, I think. Okay, and then number 3. Actually, it is. I should change the order. It is 3. Find the portfolio allocation that maximizes Sharpe ratio. Okay. Assume annual risk-free rate is 1%. Okay. So if you download daily data about Apple and Ford, then daily risk-free rate is you have to divide 1% with 255, I guess, excluding business day. If you use weekly data about Ford and Apple, your risk-free rate is 1% divided by 52. Okay. Any question about homework? So actually, this is about mathematics. Number 3 is mathematics. So please don't write the answers with hand. Okay. Please type the answer. Okay, and submit it. To give you the hint, actually. Where is your presentation file?
I just quick.
Okay, that's fine. Anyway,
I will upload into Google Groups.
okay. Okay, which means that I cannot give you the hint. Okay, I can give you the hint. No, I mean, if I give you the hint, the problem is too trivial. Okay. So anyway, do your best. I'll not give you any hint. I mean, it is easy, right? You know how to calculate portfolio covariance, right? And portfolio variance, right? Given portfolio weight W and 1 minus W. And for risk-free rate means volatility variance is 0, right? Variance 0 means that it is basically minimization of the variance part with respect to W, given that correlation is -1, right? So to calculate minimum value, you have to take a derivative with respect to W, and then set it 0, and you can solve it, right? I'm assuming you can do differentiation now. Okay. Yongwon, you know how to solve this problem, right? Let's use this presentation.
I could try, but I'm not sure.
Okay, then I can. Okay. Okay, portfolio variance. Portfolio variance, basically W square of the Apple. Let's say W is allocation to Apple. Okay. And then it is the fourth, right? And then this is the 2 W. Right. And then you can set it as a first case, okay? This is 1, okay? If this is 1, then basically you can write it down and it becomes, okay? Square, right? It is easy to see. It looks like this, okay? Then that's the step. Okay, I'll not give you the exact answer, but given this relationship, now it is very easy to show that. So basically, I can get rid of this part now, standard deviation. You can easy to see that from this equation. You can see that return, right? Portfolio return, which is mu is average of Apple. This is the expectation of the Ford. Mu is the expectation operator. So by investigating relation between this and this, you can prove that this and this has a linear relationship of each other. Okay. Please try. Okay, and next, when rho is minus 1, okay, rho is minus 1, then actually it becomes something like this, looks similar to this, and you can find omega that makes it 0, right? If standard deviation is 0, it has no fluctuation, right? So it means it's risk-free asset. So it means that when rho is minus 1, you can simply plug rho here, then you can write something like this. Okay, I'll give you the answer. Minus f, right? Looks like this, okay? Yeah, then by finding some value for w, okay, basically you can make this entire thing to 0, right? It is possible because sigma A and sigma F is always positive, so that is possible. So you can find W is basically, since, okay, this look like F W. Right? Looks like this. So mean, right? It is simply right. So if we take this way, if we take this position on Apple, basically you can create risk-free asset, right? Because standard deviation is 0. Okay. So actually I gave you the answer. So you don't have to do this homework anymore, but please at least do some graphical work, okay? So this means that, okay, this means that if this is the portfolio standard deviation and portfolio mean, okay, it means that suppose this is the point. This is the point of the Apple's standard deviation and Apple's mean. And suppose this is the point of Ford standard deviation and Ford mean. Then when lambda is 0. No, when rho is 1, and this point means W is, in this case, W is 1, right? In this case, W is 0. Portfolio weight, because we have 100% portfolio weight on Apple, and in this case, we have 100% portfolio weight on Apple. So whatever is changed, when rho is 1, basically it is linear, right? So we should pass these 2 points. Right? And when rho is minus 1, because we can create risk-free asset, right? Now, so this is rho is 1, this is rho is minus 1. So we can create this line. Capital allocation line looks like this. If we take short position, looks like this. And this point is basically weighted average of Apple, and then 1 minus W star Ford, such that W star is that one. Anyway, please try. Please apply this in your homework. Okay. Any other question? Okay, about next presentation, I think 2 or 1 capital asset pricing model. For next presenters, please limit your presentation into the 20 minutes, okay? Not more than 20 minutes. So about optimal risk portfolio, it is for Hemin. Okay, you do the presentation of chapter 8. And then chapter 9, 강주연, okay? Okay, so please don't make efforts to present everything, okay? Just select the most important part and wrap up your presentation in 20 minutes. Commodity index, basically portfolio commodity, generate risk and return very similar to market portfolio, which is represented by S&P 500. But other thing is that although collectively they generate risk and return like market portfolio, individual commodities in the GSCI index, their return is not significantly different from zero, right? Their return is not significantly different from zero, but once we collect them, then the portfolio looks like market portfolio, stock market portfolio. And the reason is that because diversification works. The diversification return we learned last week that contribute to the excess. So basically we call it as a turning water into the wine, because every individual return, their expected return is almost zero and their volatility is 30%. But once we form the portfolio, then suddenly they become very valuable. So it is initially equally weighted and rebalanced periodically to keep the weight equally among the individual asset, and it is not rebalanced. But anyway, both of them has much higher expected return than this one at much lower risk. And to understand this dynamics better, actually we have to know what we mean by commodity futures indexes. There are 3 popular commodity futures indexes. One is the most popular one is GSCI commodity index. And the other one is DJAIG and another one is CRB. And GSCI represents around 86% of the combined open interest of the 3 indices. And DJAIG is 10% and CRB index is only 4%. So basically GSCI is dominating the commodity index market for commodity indexes. And all 3 indexes, GSCI and DJAIE and CRB, all try to represent, okay, broadly the investment opportunities in commodity market. So it means that they should generate similar risk and return, but actually, it depends on eyes, but yeah, they are similar, but actually not similar. Anyway, commodity index, GSCI, the most popular one, is heavily skewed towards energy exposure because its portfolio weighting scheme is based on the level of worldwide production for each commodity. So GSCI is heavily skewed on energy. DJIIG focuses primarily on liquidity data supplemented with production data. And CRB is basically equally weighted portfolio. So this is the composition of commodity indexes. So if you first one is CRB, if you look at it, it's the same way, right? All 5 5.9% each. And GSCI, it is highly skewed on the energy. So where's energy? Heating oil is like 10%. Right? Heating oil is like 10%. And gas oil, and yeah, this energy has very high weight. Crude oil is, Brent crude oil is almost 30%. Right? Crude oil is almost 30%. Very highly skewed on the energy. DJCIG, it also has high weight on the energy, but not as high as GSCI. And it is the changing mix of the GSCI. So initially, the large part was live cattle, but it is getting smaller and smaller, and crude oil is very large. And about the benchmark, okay, we have commodity indexes, and to what we can compare them with. First obvious candidate, T-bill. T-bill is short-term debt obligation backed by U.S. government with a maturity less than 1 year. It is the we often regard, actually we usually regard the T-bill as risk-free. And another is Barclay Capital Aggregate Bond Index, which is used to be called the Lehman Aggregate Bond Index, and it's basically bond index. Right? It is a broad-based index maintained by Barclay Capital, which took over the index business of the now defunct Lehman Brothers, and it is often used to represent investment-grade bonds being traded in the United States. And Wilshire 5000 is broad-based market index for stock market. Okay? It's a Wilshire 5000 is a market capitalization weighted index of the market value of the all stock actively traded in the United States. Currently, the index contains over 4,500 components. The index is intended to measure the performance of the most publicly traded companies headquartered in the United States. So this is the performance. If you look at the performance, so MSCI, it is like a global index. So this is, we have CRB, DJAIG, and GSCI. And it is of course historical data, but it seems that DJAIG dominates GSCI. And CRB has much lower return, but at lower risk. Right? And it is bond index and stock market index. And it is a historical excess return of individual component of the actually GSCI. And overall, GSCI, Goldman Sachs Commodity Index, generates around 4.5% geometric mean, arithmetic mean around 6%. Interestingly, individually, okay, individual equally weighted rebalanced average of individual asset is much lower than that. Okay? Our geometric return is 2.7%, and arithmetic average return is zero, practically zero, as we saw in the previous slide. And again, the difference between these two is from diversification effect. And we can see the diversification effect seems very large. Right? And why this diversification effect is so large? Actually, next slide explains that the correlation among each commodity is very low, right? As this table shows. So since correlation among individual commodities is very low, commodity future is very low, so collectively they generate very large diversification benefit. So that can explain the difference between portfolio geometric mean and average of the geometry, average of individual assets geometric mean. And the next question is, let's go to the previous slide again. Yes?
Let's say in case of then the correlation of all of these components, especially like cotton, coffee, sugar, all of this would be like correlated in case of natural disaster.
Yes, possibly, but this is historical evolution.
Alright.
So it is possible, yes. There is always market systematically. They cannot have everything together. But at least historically, they are not that correlated to each other. So anyway, let's take a look at this chart again. And it seems that each component has very different return and standard deviation. Right? So they look very different to each other. Okay? Like copper, they have geometric mean of the 60%. On the other, silver is minus 8%. Actually, this data is only up to year 2004, but from year 2004, actually silver is the best performer, one of the best performing commodity. As well as gold. Gold is, in this period, gold is low, but after this period, silver and gold are best performing commodities. But anyway, the point is that they look very different to each other, and the question is what can explain these cross-sectional differences or diversity of the commodity return? The drivers of a cross-sectional average commodity future return over common period. Actually, we can come with some. One possible explanation is actually term structure of a futures prices. I'll explain that again. And the roll return, which is very closely related to the term structure of futures prices, is the past and the future of the cross-section of the commodity futures return. They can explain it. So, okay. First, we have to know what do we mean by term structure of commodity futures price. What do we mean by term structure of future prices? The term structure of the future prices depicts the relationship between futures prices and maturity of the futures contract. So x-axis is basically maturity, and y-axis is the futures price. And the futures price for crude oil declines as the time horizon increases from a price 40.95 per barrel of the oil for the July 2004 futures contrast to a price of 36.65 for the June 2005 futures contract. So this is an example of market backwardation in which the futures price for a commodity is lower than current spot price. Again, backwardation means commodity future price is lower than current spot prices. And the future, on the other hand, the futures prices for gold increases as the time horizon increases, and this relationship is, we call it contango. And gold has always been in contango, and crude oil has been in backwardation about 66% of the time. Okay?
Professor,
And yes.
is the contango meaning the spot price and future price is increasing at the same time?
Yeah, I'll show you graphically shortly. Okay? And before explaining that, let's remind you that while gold is a standard component of many commodity future indexes, nowadays gold is really a currency, not a commodity, and that gold futures is best sort of as a financial futures. Actually, that explains why gold is in contango. So actually, this describes contango and then normal backwardation. So gold is very small variation here, but if we look at from this to there, okay, so x-axis is maturity date and y-axis oil futures prices. Okay, actually, sorry, this side is oil futures prices, and as we have longer maturity, future prices tend to increase. This pattern we call contango. Okay. On the other hand, backwardation is this downward sloping graph. So again, x-axis is the maturity, and y-axis is again oil futures price. So it is like a snapshot, okay? So given today's data, there are many futures contracts, right? Futures contracts that matures shortly, and other futures contracts, maybe they mature in distant future. Where did he go, by the way? Abdullah left the class, okay? You are Abdul, right? What's your name? Oh, Umeraja. Okay, sorry. Okay, so again, it is very important. Actually, people a lot get confused with the notion of backwardation and contango. And indeed, it's confusing because some people have very different definition about contango and backwardation. But in this class, I want to stick to this definition. It is a cross-sectional snapshot definition. So given today's information, you can take a look at many future contracts, and you can sort current future contract. You can sort current future contract in terms of the maturities, and then check what is the future price. Get the price at which you, if you are long position, you are supposed to give to receive oil, right? So in this case, suppose you are in the long position, this backwardation means if you are in long position, and today is May 30, 2004, so which means that around next month, okay, we will have the data. May, so like 4 months later, you can receive 1 barrel of the oil. You can receive 1 barrel of the oil by paying around $40, right? And if you about what is 1 year later? Yes, so 4 months later, you are supposed to pay $40 for 1 barrel. But if you are in the contract for this one, so 2005 April. So, but 1 year later, if you use this contract, if you receive 1 barrel of the oil 1 year later, then you receive like 37. Actually, you can give like $37 per barrel, right? So it means that if you have a distant contract, you will pay less and less for backwardation. For contango, it is the opposite. Okay. So, okay. Then I have a question. Actually, did we discuss this chart last week? No, I don't think so. Okay. So suppose you are an investor, and suppose this term structure of a futures price remains same for the next 1 year. Let's assume that. Suppose you are an investor and you have 2 options, gold futures and oil futures. Which one do you want to invest? If this relationship stays stable for the next 1 year, which one do you want to invest?
Gold.
You want to invest in gold. Why?
Because now I buy low and then in a year or by the end of the maturity I sell at a higher price.
You can sell at higher price.
Or you're still talking about futures? Because if it's just commodity itself, then I'll just buy the commodity and sell it.
Yeah, they are all, it is all commodity futures.
Right? Futures.
So which futures contract do you want to buy?
I think I can short sell crude oil.
You want to short sell the crude oil. Basically sell crude oil and buy gold. It is your strategy. Why?
Expectation of price, because crude oil price will be expected decrease, and I could make some revenues with short selling, and by the money I gain after short sell the crude oil, I could invest gold, and after gold price goes up, and I could sell the gold, and with the money I can long the crude oil and close the position, and you can make some kind of arbitrage.
Arbitrage, okay. Actually, for gold, this is almost always the case in this way. And crude oil, this happens around 70% of time. But if there is arbitrage, then how can this relationship can be maintained? So clearly there is no arbitrage. But anyway, any other opinion? Hemi, do you have any different thought? Which one you are about? Gold or oil?
I guess I will buy gold.
For the same reason?
Yeah.
Actually, if this relationship remains like this for the next 1 year, actually it's better to buy oil and sell gold. Actually, can someone explain why? Okay, it's the other way. So let's think about it. So today we have this relationship, and suppose I have a long position. Suppose I have a long position on the crude oil at this point. Okay, so May 2005. Okay, so suppose I have a long position on this one. So May 2005. So next month, what's gonna happen? Suppose this relationship remains like this next month. So currently I have like this is May and okay, this is May. So I have a 12 months later, this contract will expire, right? The maturity is 12 months later, right? But if relationship this remains like this, and if I have a position at this point, and the next month now we have only 11 months left, right? We have 12 months left, and the next month we go 1 month, so we have only 11 months left. If we have 11 months left, then at this point now we are at this point, right? And another month later, now we are at this point, right? So which means that if we have a backward dated, if we take a long position on the backward dated future, then basically as the maturity shortens, as time goes by, maturity shortens, we go up this. We crawling up this downward sloping curve. Right? So we keep crawling up, and at the maturity, if maturity happens, then actually we can say at the maturity, right? At the maturity, spot price and futures price are same, right? Therefore, at the maturity, basically, we can sell our oil at this point. Futures contract at $40. We can sell our futures contract at $40 at this point, right? So therefore, it is better to invest in backwardated futures. Right? On the other hand, if we invest in the gold futures, what happens? If we have like 1 year left, then we are at this point 404. But as maturity shortens, then we go down and down, right? So we lose money if we invest in contango.
But we can long those contracts, then we can.
Actually, so I'm assuming we are taking long position. We take long. So basically, if this relationship remains stable, okay, then it suggests that we should take long position on the backwardated futures, like oil, and we should take a short position on the contango asset, like gold. So does it mean that we always have to sell the gold? That's clearly not true, right? For the last several years, gold performs extremely well. So the thing is that I assume that this relationship remains stable, and another hidden assumption that spot price of the gold doesn't change. If spot price of the gold changes, what's going to happen? If spot price gold goes up, then this entire curve should shift up, right? Shift up. So assuming then this structure doesn't change and there is no change in spot price, it means that we have to invest in backwardated asset and short sell contango asset. Any question? Actually, in the MBA class, Okay, I'll show you next class. Sorry. Anyway, this contango backwardation is a big, it's a very important issue for commodity investors. Okay. So anyway, please remember that. So if other condition remains stable, it is better to invest on backwardated asset because of this ruling effect. Okay? Once you update, okay, as the maturity shortens, basically, and the backwardated asset, you calling up is slow. So basically, you should invest the backwardated asset. Condition on the spot price remains same, and this relation remains stable. Okay, and there are several. Yeah.
Backwardation is future price is lower than spot price, and you mean as the maturity shorten, the future price is following the spot price. So because
So spot price keep increasing up to the spot price.
and that's why we must invest in backwardation, right?
Yes.
Okay.
Understood.
So there are several hypotheses, theories about what explains this relationship, why some assets are contangled and why some assets are backwardated. There are some theories about that, and actually, when we learn futures and forward contracts, actually we already implicitly learned about this theory, these theories. But let's investigate those theories through the historical perspective. Maybe one of the first, the most influential theories about this contango backwardation thing, term structure of future price, is from Keynes. So Keynes, 1930, advanced the theory of normal backwardation. So normal backwardation, so it is another confusing terminology. And normal backwardation is very different from backwardation. So normal backwardation means the future price for commodity should be less than the expected spot price. Okay. So backwardation means future price is lower than spot price, right? But in normal backwardation, it is the relationship between future prices. It is the story about expected future spot prices, right? And problem is that we don't know what is expected spot price. So in practice, actually, Keynes' theory of normal backwardation is, in fact, is very hard to apply. Anyway, Keynes argues that future price should be less than the expected spot price in the future. So if today's spot price is below the spot price in the future, then as the future price converges toward the spot price at the maturity, excess return should be positive. Okay? So Keynes' insight was that commodity futures allow operating companies to hedge their commodity price exposure. And since hedging is a form of insurance, therefore hedgers must offer long-only commodity futures investor insurance premium. Right? So the return from normal backwardation, basically we can regard it as an insurance premium. So normal backwardation suggests that in a world with risk-averse hedgers and investors, the excess return from the long commodity investment should be used as an insurance risk premium. Right? So it means that, many firms want have to reduce their operating risk. Like one with the best example, like airline companies. Right? For airline companies, they need oil, right? They need gasoline. No, it's not gasoline. Gasoline for car. What is oil for airplane? I forgot. Anyway, that is very important. So they have incentive, right? They have incentive to secure the position, and that explains why the future price can be lower than expected spot price. But Anson actually distinguished between market that provide hedge for producers which is backwardated market, and market that provide hedge for consumer. So actually, Anson extended Keynes theory such that backwardation means hedging for producers, which means that producers, right? Producers pay insurance pay premium, right? So if you buy futures for backwardated asset, in the previous case for oil, which I suggested would be a good investment if spot price is stable and the relationship remains backwardated, which means that you are basically selling, you are like insurance company. You are selling insurance to the oil producer in some sense. Right? On the other hand, there may be a market for hedge for consumers, which can explain the contango market. In a contango market, basically, if you invest in contango future, then it means that basically you are buying insurance contract, which means that you have to pay the insurance premium. Anyway, this line of reasoning suggests that a portfolio that goes long backwardated futures and short contango futures is an attractive way to allocate capital, right? The losses incurred by the hedgers provide the economic incentive for the capital market to provide price insurance to hedge. Right? So basically, this line of reasoning suggests that the excess return from backwardation is basically insurance premium you receive. Okay? The excess negative return from old contango asset is basically insurance premium you have to pay. So this is they are like a classic theory, and then there is theory of the storage about excess return. The theory of storage focus on the role that inventories of commodity play in the determination of a commodity futures price. So in this framework, inventories allow producers to avoid stock out and production disruption, and the more plentiful inventories are, the less the likelihood that production disruption will affect prices. So we have a notion about convenience yield, which is the benefit of having inventories. Convenience yield is high when desired inventories are low, and the convenience yield should be low when desired inventories are high. In the theory of storage, the price of the commodity futures contract is driven by storage cost, the interest rate, and convenience yield. And the convenience yield story suggests that inventory might be low for difficult to store commodity, and as a result, difficult to store commodity might have high convenience yield. Okay? So, to write down the equation about the futures price, can someone tell me what is the relationship between futures and spot price? We already wrote it. What is S? And then, beg your pardon?
Exponential.
And
RT.
yes, R. Yeah, R. If we have storage, yeah, actually we have storage cost. Let's assume continuous storage cost. It looks like that. And if we have convenience yield, it looks like that. And T is the maturity, right? And T is the time to maturity. So let's plot. Okay. Let's plot the term structure of futures price. So x-axis is basically T, y-axis is basically futures price, right? So suppose R plus C is greater than Y, and what's going to happen to this graph? It is downward sloping or upward sloping? Yeah, it should look like this. So it is contango. And on the other hand, if R plus C is less than Y, if convenience yield is very large, then we would have something like this. basically out of the formula we already learned can generate both contango and backwardation, and this theory is highly related with the previous story about insurance premium, but actually it can be slightly more general, right? So do you remember the Ferrari example of the last class? So in this class, if the Ferrari is the very hot item in clubs in Gangnam area or something like that, right? In this case, actually it is, if we have even higher convenience yield about the hot item, the item becomes even hotter. Basically, the slope of the futures contract about the car will be even steeper. Oh, okay, even steeper like this, like backwardated. Which means that in that example, the source of this excess return of calling the backwardated future is basically, you can regard it as an implicit rent, right? Because driving Ferrari makes you like a hot person, which means that by renting the Ferrari to other people, you should be able to receive more rent. Right? You should be able to receive even higher money from the rentee, right? Receive, right? Basically, yeah. So which means that, and person who actually bought the commodity, we can regard that they are the user of the commodity, right? And they can enjoy the convenience here. On the other hand, who invests in the future, so although they have a right on the commodity in the future, they cannot drive the Ferrari or they cannot enjoy convenience today, right? Therefore, implicitly, it means that you have to receive some rent revenue from the commodity holders, right? And so that's the story about this shape of the backwardated asset, and slight different story is the insurance story, right? But anyway, insurance, we can regard insurance as another benefit of holding, right? Holding the commodity in some sense, right? So they are kind of related to each other. So they have slightly different outcome. Anyway, it is the theory of storage about excess return. And then if we relate this with the inventory argument, actually, this convenience yield should be related with the level of the inventory, which means that if we have item, if we have a commodity which is very hard to store, right? Which if it is very hard to store, then it is maybe better to have it right now, to use it right now, right? Therefore, for the item with low inventory, then which means that which we cannot store easily, then it should have very high convenience yield. On the other hand, the commodity which we can store very well, right? Then basically we should have low convenience yield. So yes. And so basically term structure of this future basically generates a return, this excess return called a roll return. So in upward or downward sloping term structure of futures, prices create the possibility of future price roll return. So if fixed income balance terminology, an upward sloping yield curve produces a return attributable to the passage of the time, known as rolling down the yield curve, which is the very similar story. Okay. In the oil futures example, suppose it is related in the previous figure. So the futures price for July 2005 is 36.65, and the July 2004 price is 40.95. So if the return structure of oil remained unchanged between July 2004 and July 2005, then the roll return from buying the July 2005 oil contract and holding the position for 1 year would generate 11.7%. Right? For gold, it is the other. It should generate a low return of the minus 1.4%. And since futures contract have an exponent, it is a very practical. It is very practical issue for fund manager. So basically, futures contract, not like commodity spot commodities. commodity futures contract have an expiration date. So investor who want to maintain commodity futures position for long time have to periodically sell expiring futures contract and buy the next to expire contract. Right? And this is called rolling the futures position. And if the term structure futures price is downward sloping, which is backwardated asset, then it means an investor rolls from a higher price expiration contract into lower price next nearby futures contract. Right? So you sell high and buy low. Therefore, this suggests that the term structure of futures price drives a low return. So if we go to previous example, so suppose you have this position, and as time goes by, now it comes to maturity, so you are here. But if you want to take this position, maintain this position for a long time, then basically you have to sell this one and buy this one again, right? Otherwise, your contract will be expired. So you have to roll from this future to this future. And you sell high and you buy low. So basically, whenever you roll the futures contract, basically you generate excess return, which is called rolling.
Professor, deal or
Yes, futures contracts are usually very liquid, very extremely liquid. Especially those futures contracts included in GSCI, they are extremely liquid. So there is almost no liquid problem.
okay.
Any other question? So this is the one. So it is the one very interesting chart. Suppose you invest $1 at 1982 to oil futures and gold futures, and if you invest in oil futures, heating oil is if you invest in oil futures, then your position is very volatile. Okay, it spikes around this time. What happens this time? Why oil futures go spike? What?
Oil prices.
Oil crisis? What kind of oil crisis?
It's Kuwait war.
Yeah, it is. Yeah, it is the first Gulf War, right? First Gulf War. So spot price goes up a lot, which means the futures price go a lot as well. So there's one spike here, and go down, and there's another spike around Asian financial crisis, right? Something like that. And oil price keeps going up. And this is your cumulative return. So what would happen? You invest $1 in oil future, and you have to, of course, roll over the position. Of course, you have to keep roll over your future position. And what would you have in year 2004? And this excess return is around, if you invest in heating oil, you will generate around 5.53% per year, okay, on average. And interestingly, the roll return is 4.60%. So roll return, the return generated by the backwardated position of the oil, backwardated term structure, backwardated structure of the future price, that backwardated, that roll return can generate like a lot, right? 4.6%. And that part is this dotted line. And the difference between roll return and excess return, that is spot return, that is attributable to the change in oil spot price, mostly. And about gold is contango asset, right? Gold is contango asset, so which means the roll return should be negative. So on average, over this period, gold generates minus 5.68%. And its spot return is negative, and roll return is even bigger negative, right? And nowadays, gold generates a lot of positive excess return. Right? Gold futures generate a lot of positive excess return, which means that gold is still in contango. Okay, gold is in contango, so which means that low return should be negative now. But since we know gold futures generate a lot of excess return, which means the gold spot return from gold spot should be even greater. Because this is negative and we know this is positive, so this should be even bigger positive number. And it's basically this chart shows the relationship between excess return and low return even more clearly. So this axis basically compound annualized low return attributable to the term structure of the futures prices. And y-axis is the excess return. Excess return means how much you will earn by investing $1 to these commodities. So they have this positive relationship. So it means that although spot price, change of the spot price or change of the valuation or change of term structure interest, that may make low return unstable, but still low return can explain a lot of the excess return. Right? So it means low return is important determinant of the cross-sectional variation of futures return. Oh, sorry, we are time's up. So we are kind of behind the schedule. Okay, but anyway, do you have any question until now?
Shall that be term?
Okay.
And where should we submit our
The Google groups.
Google groups?
Yeah. Okay. So everyone can guess every other's grade, I guess. Because you can see each other's written. So anyway, see you next week.